Black Monday is the worst day in S&P 500 history. The market crashed over 20%, and Paul Tudor Jones, unsurprisingly, was short. So he was short futures, and the reason he used futures is because of leverage. You can typically get about 20x leverage, so $5 million controls $100 million of exposure, and he was also long put options. The put option is essentially you're making a levered bet on a stock to go down. So in 1987, Paul Tudor Jones looked at a graph of the market, which was euphoric at the time. However, he realized this looks exactly like 1929, the last stock market crash. And Paul Tudor Jones started to think this is a bubble. The market has to crash eventually. And he also realized that a lot of funds were using early versions of the quant stop loss. So essentially they start selling to minimize losses once the market starts selling off. So if the market starts going down, there's going to be rapid selling and the market could really go down. The first few days of October, the stock market started to go down, so his fund started to make some money, but he just kept doubling down, and he continued to add to his position until Black Monday when the stock market crashed over 20%, and on that day, he made an absolute killing. Once again, this trade kind of had an asymmetric risk-reward ratio. Paul Tudor Jones was only risking 5% of his fund with a risk-reward ratio of 20 to 30.